sort of standard disclaimer here. This is the same presentation that's on our website, and I think will be distributed by shares if I'm not incorrect, so feel free to read at your leisure. The background on Trident Royalties before I jump into sort of the strategy and what exactly we do is we listed 2.5 years ago, AIM-listed company. We did a $20 million equity raise in June of 2020 at 20p a share. And at that time, we had one mining royalty, and I'll talk to what those are in a moment. But you fast forward to today, we're sort of trading around 50p a share, and we have 22 mining royalties, about a dozen of which are cash flowing. We've grown from exposure just to iron ore via a small royalty to exposure to iron ore, copper, gold, and most significantly to lithium, and looking to obviously increase and broaden our exposure from there. But look, stepping back for a second, for those not familiar with mining royalties, they're obviously slightly different instruments relative to investing directly in mining companies, whether by equity or debt. The key thing is that a mining royalty, it's an instrument such that the royalty holder is entitled to a percentage of revenue from the underlying operation. So that's a slightly different style of exposure relative to equities, whereby in equities, obviously on the profit and loss statement, you're exposed to the profit or loss side of that equation, effectively bottom line exposure, whereas royalties are exposed to the top line, in other words, just the revenue. So if the operation is generating revenue and we've got a 1% royalty over that operation, then for every $100 they generate, we're entitled to $1. Now, what that style of exposure means is that obviously a mining company can have profitable years, can have unprofitable years. But we're not exposed to that sort of cyclicality because we're not exposed to their operating costs. So it's highlighted in an environment like we're in today with sort of hyperinflation. What you see is that's pushing up metals prices ever so slowly. Metals prices are increasing, but so are the OPEX of the underlying operators in that their operating costs, the cost of employees is increasing, the cost of diesel has grown significantly, and so that bites into their profit margin. But our exposure being only at the revenue line item means we get the benefit of the increased commodity prices, but not exposed to the cost side of the equation. So in that sense, very much a derivative style of instrument where you're getting direct sort of commodity exposure and in essence, a direct inflation hedge. Now, the reason it differs from, say, getting exposure via the direct commodities, which is often a question we get, is if we're sort of proposing that royalties are a better means to get mining commodity exposure relative to just investing directly in the mining companies, why not invest directly in a commodities ETF if you want exposure to copper, for example? And really the driver behind that is because then you lose the asset-specific attributes. So that's the reason people invest in mining equities, is because over 80% of mines that are built to either extend their mine life or increase their production profile, their throughput. It's the reason people invest in mining companies, and you don't get that exposure if you're just directly exposed to the metal. So mining royalties are sort of a pretty unique instrument that threads the needle between equity style exposure and debt style exposure. We sit senior, probably senior most in the cash flow waterfall, typically senior to equity with regards to security waterfall. And then, as I described, it's sort of different style of exposure that insulates investors from the direct operating cost profile. And here you'll just see there's primarily gold-focused royalty companies, which I'll speak to in a second. But what this chart is articulating is the big three gold mining-focused royalty companies relative to the gold miners ETF. And what you'll see is obviously all three have outperformed gold equities. And actually, I'd encourage you to look at mining royalty companies across the board, almost universally outperform their sort of equity peers. And then I guess that brings us really to then what we're doing differently. What you see at the top donut chart there is the breakdown of the global mining sector. So you've got roughly a third precious metals, a third base metals, and then a third bulk commodities like iron ore, increasingly battery metals, and then industrial minerals. All these sort of core things that feed sort of the industrial machine of the world. But yet the mining royalty sector in the lower left donut chart is dominated by gold-focused royalty companies. Part of that is just sort of the inception of the industry. It was born in North America, primarily in Canada. And there have been some very big success stories. The biggest mining royalty companies, sort of circa 30 billion market cap, so big companies. In aggregate, the sector is an $80 billion sector. But what you've had is sort of the first few were very successful, and then there were sort of a second cadre that came through and mimicked the model of the initial guys. And then that's kind of where we stand today. And so what we're doing differently is building a portfolio that's more representative of the mining sector as a whole. So we're opportunistic when it comes to gold exposure. What we won't do is compete with our 20-odd TSX-listed gold royalty peers. Most of our gold exposure comes from Australia or Africa, but really the focus is on base metals and battery metals. So what you'll see is of the $80 billion mining royalty sector, only 7% of that is non-precious metals focused, and of that 7%, a full 70% is just two royalty companies that have large single iron ore royalties. So effectively what you've got then is a 30% subset of this 7% that's looking at sort of the broad diversified sector. And I guess that's the glaring value dislocation that we saw. And the reason we jumped out of our previous employers, we were all at various mining private equity funds and launched Trident, was we'd often do equity or mezz debt investments and tack on a royalty. And if it was a gold royalty, you could sell it to any of the 20-odd listed Canadian royalty companies. They'd bite your hand off for it. But if it was a non-precious metal royalty, there's just not a natural home for it. You can count on one hand the number of parties that would buy that royalty, despite the fact that it's over 2/3 of the mining sector. So that was the dislocation, and that's the portfolio we've set out to build. When we initially listed, we'd secured one royalty, and we did our initial raise at 20p a share, as I mentioned, and obviously it's nice to show a share price moving up and to the right, particularly in this environment. As I mentioned, we listed at 20p, and we're sort of, I think today, at 49.5. But what's more important on this chart is just the deal velocity. You can see annotated on the share price chart the deals we've done. So a total of 11 deals to date for a total of 22 assets in the portfolio. So, you know, when we first listed, it took a bit of a leap of faith, to be fair. We'd secured one royalty, and I think investors liked the strategy. It's intuitive, but didn't know if these royalties were out there to be had. And I think where we're at today is sort of through that proof of concept phase, and clearly the royalties are out there. So now it's a matter of sort of scaling out the portfolio. And the other thing to mention on this chart is it's a little hard to see because it's a dotted yellow line, but just the increase in liquidity as we've grown. For a young company, we've got pretty good liquidity on the market, such that investors can get in and out. There's a very liquid market, which can sometimes be an issue for junior companies. I won't drag you all through, obviously, the entirety of our portfolio, but a couple things to highlight. On this chart, you can see geographically the spread of our assets. The key thing, I suppose, is 63% of our assets on a NAV basis, net asset value, are in Canada, US, and Australia, so very good mining jurisdictions. And we'll look anywhere. We've got an asset in South Africa. We've got one in Zambia. So we'll look geographically. We'll price in that risk. But I don't think any of our investors want us to become a frontier markets offering. So we'd like to keep that proportionality as it is. The other thing worth flagging is some of the, we flag them here as royalty partners. Effectively, these are the operators of the assets, some of our key assets. And I think oftentimes there's a misconception. People assume because we're a junior royalty company that ergo all of our assets are over junior-led projects and or swing production or the first to sort of shut down if the commodity cycle changes, when in fact it's almost the exact opposite. All of our key assets are led by mid-tiers or majors. Lithium Americas is a $3.5 billion market cap company. Ganfeng is 20 to 30 billion on any given day. Equinox Gold's a couple billion. So good, solid operators with good balance sheets. Obviously, the royalties are right size for our portfolio. Obviously, we'd be a multi-billion-dollar market cap company if they weren't, but not quite there yet. So the right size for our portfolio, but good operating assets and good operators. I won't drag you through the detail of the profile, but other than to flag that you can see sort of the broker consensus of our revenue profile, sort of growth exponentially. Last year our revenue was a little over 1.5 million. This year I think the brokers have us at sort of 13 or 14 million consensus, and you can sort of look at our numbers through Q3 and we're tracking towards that. But really the key thing is that this is the portfolio we've built in the 2.5 years we've been listed, obviously not looking to stop now. If anything, our access to capital as we've gotten bigger and more established has gotten better. So I think it's that coupled with the fact that most operating companies are feeling the pain. Their share prices are down 30% plus this year. So they're looking to bring in capital, and whereas an equity raise for them would have been more appealing, say 12 months ago, now a royalty is sort of a more viable option. So I think we're pretty confident in the pipeline at the moment and the ability to continue to grow the portfolio. The other thing worth flagging is there's a breakdown of our portfolio by asset stage. So producing is just under half of our portfolio, but a good chunk of our value is in development or exploration stage assets. And the reason I flag that is when you look at some of the valuation metrics of us in the sector as a whole, we're the best performing royalty company this year. In fact, I think a touch up from when this was drafted. And that's on that sort of re-rate from cash flow, because royalty companies, because we have so many underlying assets, the biggest company has hundreds and hundreds of royalties they've accumulated. So people tend to not value each individual royalty. They take your cash flow metrics and just sort of slap it with a multiple, and that's how they arrive at your value. And so because we've increased revenue sort of nearly tenfold this year, we've seen a re-rate in our value, and that's been reflected in the share price. But the fact that over half of our NAV, of our net asset value, is in development stage assets, we still trade at a discount to net asset value because that cash flow is not yet cash flowing. Maybe assets that are very thoroughly de-risked and a couple years from cash flow, and you've got good line of sight to cash flow. But until it materializes, the market just doesn't give you the full value for that. Hence why we're out here doing things like this, is to obviously pull forward that value realization. And I mentioned I won't drag you through, obviously, every single asset in our portfolio, but it's worth dragging you through one, if only to sort of flag how we source our royalties, how we price them, what kind of return hurdles we're looking for. And Thacker Pass lithium project is a good example to use. Primarily, it's our largest royalty on a NAV basis. It's not yet cash flowing, but probably about 25 to 30% of our NAV, depending on sort of price deck you use and some of those assumptions. The backstory of how we acquired this royalty was it was written by a private equity fund about 11 or 12 years ago. So two things important about that. One was obviously lithium isn't sort of the critical component it is today for EVs. It's obviously in pretty much every battery chemistry, and of all the battery designs that engineer out different commodities, lithium is the one constant that's in pretty much every battery design. So lithium wasn't quite as critical back when this royalty was written, and also Thacker Pass was an early stage exploration asset. You fast forward sort of 10, 12 years since that royalty was written, and Thacker Pass is now the most significant lithium asset in North America, the most advanced lithium asset in the US, and domestically we don't really produce any lithium. It all comes from abroad, produced primarily in South America and in Australia via Korea for processing. So there's quite a few incentives now, quite a bit that was baked into this Inflation Reduction Act to incentivize domestic critical minerals development, and lithium sort of tops the list for that. So Thacker Pass, the key catalyst for us was in January of 2021. We were aware of the royalty, but in January, the operator, Lithium Americas, received their final key federal permit towards construction, and then later that week raised $400 million towards construction in an oversubscribed equity raise. So suddenly two of the big key hurdles for any mining project, permitting and financing, were sort of cleared. So we were on the phone that day with the PE fund that holds the royalty, and sort of within a week had secured exclusivity and bought it about a month later. Now, the way we were pricing it, and it's a little hard to see on here, but this is the cash flow sort of to Trident for our share of the royalty. We priced it on $12,000 per ton lithium as a long-term price, and we were modeling a 16% post-tax IRR. Important to flag that that's a 16% IRR for a total of a 46-year mine life, which is the base case of the operation. Now the resource is 4 times the size of the reserve, so ample capacity to expand that mine life or increase production, the planned production profile. And indeed, after we bought it, then the operator did increase the planned production profile by a third, which highlights the benefit of royalties. So that increased production profile, their equity, their shareholders are going to have to pay for that, because that's going to mean a larger plant, a larger footprint, all the costs associated with that. But we get the benefit of the increase in planned revenue. And so that immediately bumped our base case IRR to circa 20%. And then obviously lithium's not at $12,000 a ton, it's north of $80,000 a ton right now. I think anecdotally we're using $55,000 a ton in this waterfall chart. So at $55,000 a ton, you can pick your lithium price, but at $55,000 a ton when fully ramped up, the royalty would pay us $45 million a year, again for 46 years. We bought it for $28 million. There's a partial buyback on the royalty too, to buy it down from a pretty egregious royalty rate to a more manageable one. all assumptions, our assumptions as well as the operator assumes that they'll buy that down before they actually start producing. Otherwise, it would cost them tens of millions more over the life of the project. So effectively, we'd be on risk for $14.8 million and have sort of this $40 to $50 million per annum revenue profile from the asset. So I think that highlights kind of how we're sourcing these things, how we price them, how we look at risk. The kind of final key hurdle for this one is the permit's been issued. With the U.S. permitting process, there's one final opportunity to challenge it. The final hearing for that's scheduled for January 5th. Our expectation and the company's expectation, the operator's expectation is that it'll be finalized in Q1 next year, and then from there they're going to kick straight into construction. And it's about a 2-year construction cycle before it's in production, which accounts for sort of this uplift in revenue that you can see there. We sort of forecast it turning on in 2025. So I won't drag you, in the interest of time, I won't drag you through the other assets. Other than the flag, we've got a royalty or an option to buy a royalty over the Sonora Lithium project, which is actually in construction now, so sort of de-risked from that perspective. We've got a royalty over a copper project in Zambia, which has just produced first copper cathode and is ramping up their stage 1 production profile. Again, they raised $85 million in equity earlier this year, and then just last month raised $50 million in offtake financing. So a well-capitalized operator. They've increased their planned production profile since we bought the royalty, but we get the benefit of all that capital flowing into the project. And I won't drag you through all these, but it's just to highlight that, I spoke to Thacker Pass, but there's a whole list of assets within our portfolio. And once you acquire these assets, they have this organic growth on their own. That the projects advance, they expand production, they raise capital and put it back into the project. As the royalty holder, we can't be diluted because we're not equity. So we just have our percentage of their revenue. And as the assets advance, we see the value realization from that. And then obviously there's new acquisitions that will add to our NAV per share. When we initially listed, it was really just acquisitions that drove our share price, whereas now you've got sort of all these events within the portfolio as well as new acquisitions. And then the final bit is our capital structure. Just a couple things probably worth flagging here. One is when we first listed, most of our initial shareholders were either mining-focused funds or resources-focused funds, generally groups that sort of knew the landscape. And although we only had secured one royalty at that point in time, could sort of approach it and understood the sort of trajectory, what we were trying to build, and saw the opportunity. As we've grown, we've got the likes of BlackRock on the register, Amati. We're getting more and more of the sort of generalist funds that are investing in us for their commodity exposure. They like the model and the assets that we have today, and obviously the intent to build on that. We've also got quite a few of the good UK institutional investors, sort of just below the 3% reporting threshold, so took a good sort of toehold position with the means, obviously, or with the eye to increase that over time. In fact, one of the bigger names, had to waive their sort of minimum market cap threshold to be able to put in some capital in our last equity raise. And then on sort of access to capital, we've got sort of over $22 million in the bank at the moment. We have a $40 million debt facility, which is fully drawn with Macquarie Bank. Worth flagging, Macquarie is obviously a big lender, particularly in the mining space. They'd never backed a royalty company before, so it was quite a vote of confidence that they backed us and put $40 million in. But obviously their intent is to expand that facility. $40 million is relatively small for them. They want to grow that facility as we come to them with deals that they can lend against and build the portfolio. They want to be able to do that. Their job is also to deploy capital. And as we do so and our portfolio becomes de-risked and larger and de-risked, then we would expect to see the cost of that capital decrease over time. And then the final thing worth mentioning with my final minute here is the way that management's incentivized, a pretty important consideration for investors. Primarily it's options, so we're equity incentivized, and I think entirely aligned with shareholders in the sense that although we're trading at circa 50p today, the bulk of our options have a strike price of 50p, but the vesting conditions are 80p to £1.20. So we've got to get the share price to those levels, maintain it there for a minimum period of time, and then they vest. And when they vest, obviously they're in the money, but obviously shareholders are happy at that point in time because we've got to get the share price up 60+% for the first tranche to vest. And I think with that, I'm just about out of time, so I'll hand it over to questions.
Thank you, Adam.
Yep.
Excellent. So, let's clap. Yes. if you can wait for the microphone to come to you and put it underneath your chin to ask any questions for Adam coming up. Shall I start the ball rolling? There's one at the back there. Peter, thank you.
I'll ask the obvious one. When are you going to start paying dividends? When do you plan to start paying dividends?
Yeah, we get that question a lot. Whoops. I'll go back to our revenue profile. I think at the moment, our target, I failed to mention, actually, our target internal rate is a 15% post-tax IRR. That's if it's something nearer to production, then we can push that one way. If it's something further from production, we'll push it the other. But in general, that's our range, our target hurdle rate internally. And we're finding deals, obviously, at that hurdle rate. So a long-winded way of saying the intent for the time being is to continue recycling capital into the portfolio. But I think when you see this sort of revenue profile start to materialize, clearly at that point in time, we can also support a dividend and not really eat into our ability to continue to add to the portfolio. So probably still a good couple years away, but moving in that direction.
Okay, anybody else? This gentleman here, tell, please.
One question.
No, hang on, sir.
Oh, sorry.
Thank you.
One question. Are you AIM registered? AIM listed?
Yep, AIM
you
listed.
are? Okay, so it will qualify for IHT then?
No, I don't believe we do. We've explored
It
this
doesn't.
before, but I don't think we do. Yeah.
It doesn't? Oh, right, okay.
Yeah, there's a gentleman behind you, sir. Thank you very much.
So you mentioned your debt. Is it fixed or is it going to grow with the interest rate going up? Is you fully
No,
drawn down
it's
on it?
it's floating. Yeah, it's a floating rate. So it is going up. That said, we're sort of in constant discussion with Macquarie about sort of right-sizing that given our risk profile. So kind of a constant work in progress, but our anticipation is that we're going to be able to chip away at that rate over time.
Any other questions coming up? I've got one question, a couple of questions for you, Adam. How can royalties be an attractive asset during inflationary periods?
Yeah, I think touched on that a bit, but when you compare it to equity, I suppose, particularly in an inflationary period when you have costs rising, you have that translating into higher metals prices, obviously, as well. But in an environment like we're in today with costs increasing, a lot of the miners, the reason they're off so much is because their costs are getting out of control. And you tend to, in fact, we've seen it again this time, you tend to see this pop in commodity prices. And then because wages are a little bit stickier, there's a bit of a lag, but they almost always regress back to the historic mean with regards to profit margins. And then you get this sort of interim volatility period, whereas royalties don't have that style of exposure. If the commodity price goes up, we get the direct exposure because we're very simple to value. It's the production profile of the operator times the commodity price times our royalty percentage, and that's our revenue. So there's no other inputs outside of that. So it is treated as a very, very much an inflation hedge, which is why there's so many gold royalty companies. Because if you want gold exposure, a gold royalty company is probably the best sort of derivative style means to get that.
Okay. The Sonara project, is that a particular exciting project, and why so?
Yeah, it is. I didn't really touch on it much, but it's this one, we've got the right to buy 50% of a royalty, so we probably haven't been aggressive enough marketing it. But this is an asset that's operated by Ganfeng, which is the big lithium, the biggest lithium company in the world, a Chinese company, and they actually just recently announced their intent to build. It's in construction now, and their intent is for this to be a 50,000 ton a year hydroxide producer, which has a similar revenue waterfall to what we had for Thacker Pass. In that there's been a planned production expansion when we bought the royalty. The planned production profile was 37,500 tons a year. It's now 50,000 tons a year, so a 43% increase there. And then, again, we were using $12,000 per ton lithium price, and hydroxides trading sort of closer to 85,000 a ton right now. So sort of similar style revenue profile to Thacker. Once fully ramped up, I think we got it at about 55 million a year. And slightly closer to cash flow in that it's already in construction, whereas Thacker Pass probably have a quarter or two to go before they kick into construction meaningfully anyway. So I think the key catalyst for us on this one is to actually exercise the right to fund the acquisition. We'd like to see it de-risked a little bit further, a couple key hurdles for that, but generally anticipate buying that royalty this year, and we've got the right to it, so there's no sort of risk of losing it.
Okay. Over here, Hatel, please, would you? This gentleman. Thank you.
You buy into royalties. Do you ever sell some of your existing assets?
We haven't to date. Generally what you find is royalty companies because they've got this inbuilt optionality that I've spoken to. You extend the mine life, or there's a new discovery and increases the planned production profile. People sort of loathe to sell them. That, and you get sort of the natural sort of management stickiness, where the bigger you are, the bigger they can pay themselves, all that sort of thing. So I think the way we view it is whatever makes the most sense for shareholders, whatever's NAV per share accretive. So we're open to it. Generally, we're looking to build a portfolio, not sort of whittle away at it. But if we're offered egregious value for one of our royalties, then it's something we'll contemplate. And we've had a couple discussions in the past, but nothing sort of consummated to date.
Okay. This gentleman over there. Thank you, sir.
Your main revenue is the royalties at the moment, and do you have any other sources of income apart from the royalties?
No, we only hold royalties. Our mandate allows us some flexibility, because often what you'll find is you can do a royalty, but the operator wants you to take some equity alongside that. We haven't done that yet, but we've got that flexibility.
So what's your margin or profitability as in the inflationary period?
Yeah, so I didn't touch on that, but royalty companies tend to be very low sort of cost companies. We're a small company, and you've got half the team here today. There's only 4 of us in total, because you're buying these assets, and we're not operators. We don't operate the assets. We monitor them, and we have the royalties audited if they're paying. But outside of that, we don't have a cast of thousands. In fact, I always like to point to Royal Gold, because they're down the street from me in Denver, but they're a $7-8 billion market cap company and have 25 employees. Franco, the biggest player in the space, is 30 billion market cap, has 38 employees. So they're very scalable businesses. You can see our sort of projected revenue profile per the broker consensus here. Our G&A is sort of plus or minus $3 million a year. A lot of that's deal dependent. Obviously, you've got salaries and listing costs and brokers and all that, but the bulk of it is how much we're spending on lawyers and technical consultants looking at deals. So there's a bit of variability into that. And then the cost of servicing debt, which this year is sort of a little over $3 million. So between that $3 million G&A and the $3 million in debt service, and then sort of projected $13-14 million in revenue, we are cash flow positive.
Okay. I've got another one for you. Just to highlight in your presentation, in terms of lithium projects, are they your main focus?
No, they're not. Incidentally,
gold and copper as well?
Yeah, we're open to any commodity, any mining commodity. We don't do oil and gas. That's just not our area of expertise. But yeah, we're open to any commodity. It really comes back to the general strategy, which is the mining sector, sort of this general breakdown, and we've got exposure to copper, iron ore, gold, and lithium. That said, we'd love to add nickel, graphite, rare earths, all other commodities, and get sort of a broad, sweeping exposure. Really, the intent is, if you fast forward a few years, for people's mining exposure, if they could buy one share in Trident and say, via that share, I've got exposure to the full depth and breadth of the mining sector, and that's my exposure, almost index fund-like exposure, but via royalties. That's the ultimate objective, but obviously going to take some time to get there.
I mean, would it be fair to say that will the bubble burst with lithium, do you think? Or is it still going to continue to grow and be popular and needed, and the price is going to hold up?
Yeah, it's certainly going to be needed. Yeah, the sort of innovation in batteries, as I said, it's you've got this really unique situation where the demand is legislated. We flagged recently that California, you can't sell an internally combustion engine from 2035 onwards. So you got demand that's sort of legislated into the market. That's never happened as far as I know in mining commodities. So the demand is materializing. We're already seeing it. I think Macquarie just forecast 100 to 150,000 tons of incremental lithium demand every year from today. But it takes a long time to discover a deposit, to drill it out, to do the studies required to build it, to fund construction, and actually build the thing and permit it. It's a very long process, and that's why you see commodity prices sort of peak and trough, is because it's impossible to line up supply and demand sort of to work in tandem. So our expectation is that lithium's going to hang in there for quite a while, because it's going to take a while for projects to get online and satiate that demand. That said, as I mentioned, we were using $12,000 per ton lithium. We're not modeling internally 80,000 in perpetuity, so anything north of 12,000 is incremental improvement over what our original return hurdles were targeting.
Okay. Any other questions? The gentleman down there, please.
Thanks. Picking from your question on lithium, so do you think lithium in any way interferes with climate risk? And if yes, do you think your projections will hold?
Sorry, what was that?
Climate risk, does it interfere anyway with climate risk? And in the medium to long term, with your projections of 350% growth in 4 years, do you think the projection will hold?
In terms
I mean, what are your assumptions? Can you elaborate on your assumptions a bit, especially with the development stage?
Yeah, well, I mean, I think climate risk obviously plays in favor of lithium in particular, 'cause, it's a key battery component. So for electrification, lithium, there are other commodities that play into it, nickel, cobalt, for example. But I suppose lithium's the most secure in that regard, in that it is across all battery chemistries. So it doesn't, at this point in time, it doesn't matter which way sort of electrification moves. Lithium is a key factor in all those sort of designs. And the revenue profile here, I'd have to look at what the brokers are using, but they're certainly not using 80,000 per ton lithium. I think Libram, which is one of the forecasts used in this, is using, I want to say 15,000 per ton long-term lithium price. So, you know, obviously if they were using spot prices, these numbers would be sort of through the roof. So hopefully we're baking in a bit of conservatism, I guess.
This gentleman here.
Hi, quick one. Thank you. Three actually. How long are the royalties? How long are they for? Normally, I think you have to renegotiate at a certain point, so that'll be an amount of uncertainty. Secondly, I'm concerned about your figures that you say you raised £22 million or dollars, but you got £40 million of debt. So it doesn't, to me, to be a cash generative company at the moment. And what is the rate of interest for the debt? When the rates are this high, doesn't it make sense to pay off your debt? But then do you have any capacity to expand in the future if you have no cash?
Yeah, good questions. To answer your first one, all of our royalties are over the sort of particular license areas in perpetuity. That's one of the benefits of royalties, is they're generally over that piece of ground forever. The operator could go bankrupt, and in most jurisdictions the royalty remains, it never goes away. In fact, there are lots of instances of a royalty that was written years and years ago. The operator produced and then shut down, and then somebody else picked up the ground later when the commodity price lifts up again, and they turn the project back on, the royalty starts paying again. So no, these things, we never have to renegotiate them. They're there forever. With regards to the capital, that's a good question, because it's sort of key to our growth, and obviously something we're sensitive to given we're equity incentivized, is how do we grow this thing without sort of constantly issuing equity. When we listed, we raised $20 million at 20p a share, but we've done two subsequent raises, one for about $30 million at 34p a share, and then the next one at $40 million at 36p a share, and then we're hovering around 50p a share right now. So, you know, there's a few factors that play into, I guess, how we can service new acquisitions. The first is we've got 20 odd million on the balance sheet, so we've got cash to deploy at the moment. The other factor is a lot of the acquisitions we've made to date are existing royalties. What you tend to find is mine operators are constantly selling properties or swapping properties, and oftentimes when they do, they'll retain a royalty, almost as a bit of a face-saving exercise. If they've sold something that's going to turn into the next great copper mine, they want to have said we've retained some exposure to that. But then when they sit off balance sheet, oftentimes they sit in somebody's bottom drawer and they don't get any value realization. So we'll go in and buy them and effectively aggregate those into our royalty portfolio. So most deals we've done have been of that nature, where they're existing royalties that we've acquired. And the reason I mention that is because we can use our paper. In fact, all of our existing royalties that we bought, we've used Trident script as well. So, you know, from the seller's perspective, they're getting some cash, but they're also swapping out their single royalty for exposure to our portfolio. So, and then I also mentioned Macquarie. 40 million is a relatively small debt piece for them. They're looking to grow this thing to north of 100 million as our portfolio de-risks, and as we make more acquisitions, they're in the business of loaning money. So I think between the ability to draw down more debt for the right deals, the ability to use our script, we are cash flow positive and adding to our cash pile with the existing revenue profile we have today. So between sort of those three levers, and then if needed, ultimately go back to the equity markets for a raise. But we're very sensitive, I guess, to dilution because our objective is to get the share price up as much as possible. So sort of sensitive to going back to the equity markets too frequently. But that is an option that's open to us. So between all those different levers, I suppose we feel like we're well positioned to keep adding to the portfolio. It was actually in the early days that we were most at risk because we raised 20 million. And then it was kind of fingers crossed we can pull this together and get off the ground. And luckily we're through sort of that higher risk phase, and now we're feeling like our access to capital is pretty good.
Okay, Adam, thank you very much. Thank you very much for the questions.